Folks, are you ready for the stock market breakout that might be on the cusp? Is it true? Are we going higher? Well, we have the one and only Mr. Dan Bird, who comes back every week and tell us what happened in the stock market last week, where we are with the market this week, and what may or may not happen next week. This is all probabilities and possibilities, but it's always fun to talk about. Dan, what'd you see last week? What's coming?
What a way to open up.
I have some fun with it.
We're just chatting before you started, and I'm like, well, we can talk about the breakout. Oh, the market's going up.
Well, it's actually interesting because I remember our conversation from last week. You actually pointed to the chart, and you have a playlist. People can go back and watch it. It's just called Dan Bird. And when I saw the market take off last week, my only thought was, that's what Dan told me was going to happen. That's what I was thinking.
Yeah, it's interesting. We'll look at it in a second, but it's really interesting where we are right now. It's actually pretty fascinating the way all this works. By the way, I'd like to give a plug for one of the books that I recommended last week, the new ones that I added on.
Yeah.
From my time at VectorVest.
Sure.
The one that's called The Best Loser Wins.
Okay.
I'm reading that now, and it's really a very good book. If anybody's interested in being a trader, even an investor to a large degree, but a trader for sure, I think it's a great book. And I had one of your listeners sent me a note saying, I'm starting out with this. I'm trying to learn. And what do you suggest? And I'd like to someday be able to trade full time. What do you recommend? What book should I read? And I said, well, the first book you should read is The Best Loser Wins. And if you still want to do it after reading that book, then I'll give you more suggestions.
There you go. Well, folks, what I'm going to do here is put in the first line of the description a link to Amazon Best Loser Wins. So if you just want to click on it, get the book. I will be ordering it today because I have a trip coming up, and everybody knows that I like to read books on airplanes. So I will be reading that book very shortly.
Yeah, the other ones I recommended too, they're not all trading books, by the way. Some of them are just psychology related. But this one's really good because he kind of lays out the statistics for traders in the beginning. 99% do not succeed. That doesn't mean they lose all the money.
Right.
But 99% don't end up doing it as to generate income.
There you go.
1% do. And he said, you can learn about charts, and I've done a lot of studies on charts. Obviously, you can be really great at understanding charts, and you can be really great at understanding fundamentals. You can know all of those different things, and those are very important. But if you don't think correctly, you will not succeed.
Very cool.
He said that this whole thing is about how you think, not what you know.
Very cool. Well, let's jump into what you saw last week, because again, this is something you called Show Your Newsletter, because people need to be getting it.
All right, let me share. So here's some excerpts from this week's newsletter. If you'd like to receive it, there's no charge. Just send me a note to breakpointtrading@gmail.com. And I'll add you to the list. I'll send you last week's, which has some of these things that you're seeing here. We're going to talk about the January effect in the next session today.
Okay.
I thought this was funny, though.
Yeah, I thought that was good, too. We'll trade for a car or better offer.
dozen fresh eggs for a car. Last week I showed this. The things that have gone up the most with inflation, and eggs is at the top of the list.
Yeah, 49%.
Interestingly.
Crazy.
So I thought that was pretty funny.
Yeah, good.
And then we'll talk about the FOMC meeting that's coming up on February 1st and CPI. We'll talk about that in this session, CPI from last week.
Wonderful.
All right. So let me show you some charts here. All right, let's start with this one. So this is, I talked about this last week a little bit. Last week we were down right about here. I talked about the two Fibonacci levels on this one.
You did?
And the two key ones, which was at 4,000 and 4,300.
Yeah, I
And we
remember you
were
calling 39.91, and I think it closed at like 39.99 or something. I'm like, damn, he did it
closed
again.
at, yeah, 39.9909 was
Crazy.
the close. But I said 4,000 was the level.
Mhm.
You know, the other Fibonacci was at 39.98, so
Yeah.
roughly around 4,000.
Yeah, you
So
could you could
we
not have
closed
been you could not have been much closer.
91 cents off of it.
Yeah. Darn it. Come on, get a little closer next time, won't you?
Well, the important thing here is that that's a key resistance level.
Mhm.
So while we made it to it, that doesn't mean we're going to go through it. That's the breakout that I mentioned before we started.
I got you. So we could go either way.
We could still go either way. It's resistance. You don't want to anticipate the market.
Right.
You want to trade the trend, but don't anticipate the trend. So we're at a critical juncture right now.
Mhm.
You know,
Awesome.
last week, these are 1-day bars. Or last week we were down here,
Mhm.
right at the 50-day moving average. We made it through that. We made it up to this very important 4,000 level.
Yep.
If we do get through it and we get up to 4,100 or higher, actually higher, because that's where the previous highs were. You see these two red arrows right here.
I do. Yep.
So that's where it hit this downtrend line that's been there all year. It hit the 200-day moving average. We are again right at the 200-day moving average, which is at 39.81. So we're a little bit above it.
Mhm.
Very important resistance. If we get through it, everybody that's been short this whole year, the long-term shorts,
Mhm.
have their buy stops somewhere up above this 4,100 level.
Yes.
So two things will happen if we get up there. Number one, it'll confirm the bullish chart.
Mhm.
So more people will be entering on the bullish side by buying new stocks, new purchases. But more importantly, all of those stops will start executing.
Right.
And when shorts get out of their short position, they have to buy. So those are buy stops up here, not sell stops.
Mm.
So both of those things together could force this up pretty quickly. 4,300 is also the next really important key resistance level, and that's been there for quite a long time.
Right.
And look all the way back to last year, September, October.
Mhm.
That's where we bounced off of it and went up, and then we bounced again, went up, and then we went through it, and then right here we broke down through it, and then we bounced at it and went down. So 4,300 is the next really important one. But
Gotcha.
I think if we get above 4,100, we've got a good chance of getting to 4,600, I think.
Wow. And that's basically because we'll be taking out the shorts. It'll be inflated demand. That will bring the retail trader back because, hey, to the moon again. All
Right.
psychology.
That's right.
Wow.
Yeah.
Very cool.
4,300, we might go sideways right in through there for a little while. But I'll show you why that 4,600 might be important in a minute.
Okay. Very cool. I like it.
This is a longer term weekly chart, but the same Fibonacci levels, they just also happen to line up at the same place,
Mm-hmm.
4,000 and 4,300.
Okay.
And then these bands right here, we're right in the middle. So we are reverting to the mean.
Mm-hmm.
Once again, we just went through the mean. So you see we went above it here. The mean is this dotted blue line right here.
Gotcha.
So we went above it, we went below it, we just went back above it again. But this third level up here, this 3x level,
Mm-hmm.
is that right at 4,300. Again, implying that's a really important level to get through.
Got it.
So this is one that I actually put on LinkedIn and talked about it, and I talked about it in the newsletter as well. This is we'll talk about CPI now.
Okay.
And the CPI report. In fact, this is my newsletter right here. In the beginning of the newsletter, I always put some cartoons and then the economic calendar.
Mm-hmm.
So this is last week's calendar, and you can see CPI came in right at 6.5.
Mm-hmm.
Core came in right at 0.3.
Yep.
And headline CPI was actually a little lower than expected.
Mm-hmm.
So all of that was good. Market liked that.
Yep.
Remember last week, I thought we might have a chance of coming in higher than that, but we actually came in at expectations.
Cool.
And then next week we have PPI.
Yep.
On Wednesday. Market's closed tomorrow. PPI on Wednesday. So that's another inflation number.
Yeah, retail sales as well. I mean, there's a
And
lot.
retail sales, yeah.
It's all about the consumer. And then, of course, this channel talks about existing home sales. And I didn't actually know what the expectations were. I called it this morning sub 4 million. So it looks like the experts are right there as well at 3.95.
Yeah.
Cool.
Right. And building permits too next week on Thursday.
Yeah. Oh, they're actually calling permits to go up. That's interesting.
Yeah. It is interesting. My little reluctant rental property that I have, I think I told you it spiked higher.
Yeah.
The value, and then it crashed back down again.
Yeah.
And now it's starting to go back up again.
Yeah. Good old Florida real estate.
Yeah. It's still higher than where I bought it. So
there you go.
That's good for me. So anyway, this is the chart that has the CRB, which is these commodities right here, the blue one.
Mm-hmm. Yep.
And then I've got lumber, which peaked way back here in January. And then oil and gas, the red and green lines, which
I got to tell you, when I look at this chart and I knew we were going to look at it, part of me thinks that inflation might spike higher next month. Look at that gas.
Yeah. Well, this is December,
right?
So, and that's why I said that it might not hit the 6.5,
right?
Because you can see in November it's clearly went down,
right?
And in December it actually went sideways or even a little bit up.
Yeah, it depends on when they took the survey, right? I mean, if it's happened to be at the low end, I mean, it could have looked artificially good.
Yeah, I actually think, and I haven't been able to confirm this yet, but I think that the oil and gas numbers in the CPI report are actually reported on the 12th.
Oh, there you go.
So that's right there at this low right here.
Yeah, so that's what I'm thinking.
If that's the case, it'll be higher next time.
Mm-hmm.
So it'll be interesting to see what the expectation is in the next one.
Yeah, good point. Okay.
And I put all of these in here as well. I actually found this, which showed all of the rate hikes for this year.
Yep.
Yes, we started in March. I thought we started in February, but it was actually March.
Okay.
So those are all the rate hikes for this year, and then I put them in this chart.
Okay.
For those dates. So 25, 50, 75, 75, 75, 4 75s in a row.
Mm-hmm.
And then 50. So the expectation, I think, on the next one, which is February 1st, is for 25.
Yeah. Which, oh, by the way, somebody on this call called months ago. So I'm pretty proud of that one.
Yeah, right. And if you follow the CRB, if you follow these back to where they were before the hike started.
Yeah.
The oil and gas right now is at the level it was before the hikes began.
Interesting.
And the CRB number is at the level it was before the hikes began. So if these don't spike, if they do, even if they just go sideways,
yeah,
I think that still will keep the Fed at 25.
Oh, February. Yeah. There's nothing that I couldn't imagine something stopping the Fed. They want the story, Dan. I really do believe they want to show that they want the stair step, 75, then 50, then 25. Then the conversation will become, do we go 25 again, which I think they do, or do they go 0? I think March is a debate. I think February is locked in.
I agree. And I think the narrative from the Fed now will be, we expect to stay here for a very long time.
Amen. I do not see a cut all year.
Don't expect to see any pivot, any cuts.
Yeah.
I think
the market is expecting like a 1.5 cut this year, right?
Later this year.
Yeah, for total for the year. Yeah,
right.
That's what the bond market.
I think the Fed is going to cut before they want to.
Yeah. I mean, I do not, but yeah, I mean, that's certainly a debate worth having for sure. Yeah.
Yeah. When recession really gets rolling.
Okay.
Did I have something else on CPI? Thought I did. Oh yeah, here's CPI.
The base effect discussion.
This is the base effect. This is core CPI here.
Okay. Oh, core. Okay.
This is
Because that's
core.
still going up. That was up 0.3.
Right. It's still going up, but I want to point this out. Let me make this a little bit smaller so I get it all in. For those that are listening that don't understand how this works, the base effect, basically the numbers that get reported are a 12-month window, 12-month rolling window.
Correct.
All right. So whenever we get a new number, the previous 12 months ago, 13 months ago drops off. So if you look at it back here, way back in 2020, CPI actually went down right here.
Mm-hmm.
This 4-month period right here.
Yep.
It actually went down. This top one is the rate of change. This is the 12-month rate of change. Mm-hmm. So you can see the 12-month rate of change, and that's what the window looks at, 12 months.
Okay.
Shows it going up. The one below that is the 1-month rate of change.
Oh, I got you.
Okay. So this period here in 2020, it actually went down, which makes sense because nobody was doing anything.
Yeah, the economy was shut down.
Right. Economy shut down in that little box. But then when these started to drop off and we started adding big, huge steps here.
Yeah.
Right. When everybody started going back to work and started traveling and wanted to go out and buy stuff.
Yep.
Because they've been cooped up for so long. Right. So demand picked up. So inflation and CPI started going up. So these big jumps here in conjunction with these dropping off, these negative ones dropping off back here, created this big, huge spike in the 12-month rate of change. That should have been the signal to the Fed.
Should have been, absolutely.
To start hiking. I mean, it couldn't be any more clear than that.
Yeah, and they still were 9 months behind, or 10
yeah. Well,
months
they were saying it's transitory.
Yeah.
Right.
Yeah.
And they might have had a point because it did start to go down again for a couple of months. So I maybe could give them credit to say, nah, we're not going to start hiking yet, because it actually did start to come down. And the reason it came down was because these smaller jumps right here were replacing these small ones back here. So it went down. But then when it started to spike up again, there's really no excuse. When it went above this level, which was right here in October of last year, there is no excuse why they wouldn't start hiking right there.
Agreed.
That's when it should have been very apparent that it's no longer transitory, that it's not continuing to go down, it's going up instead. We better start doing something. Just look at the charts. The charts tell a story, right?
Yeah, I agree.
So you can see also, another reason why the Fed might not have wanted to start raising is if you look at the 1-month rate of change in this period, it dropped off a cliff right here. All right. So they might have been saying, oh, I think maybe we were right. It is transitory. But then it started to spike back up again.
Yeah.
So then we got to this level here. This is in August, July, August, September. We had very small heights, very small steps back here, replaced by really big steps over here.
Yep.
All right. So inflation starts to spike up again at that point. However, it was kind of sideways, but it was up a little bit. But look at the 1-month rate of change.
Yeah. Can you scroll up for a second?
Sure.
This is why I'm telling my channel on my daily financial news that inflation has 3 components. The second component is in that blue box. That's housing to me. And this is why I'm highlighting that August of this year, you will start to see housing roll over. It's because of those, you're seeing big jumps in 2022 be replaced by smaller in 2023. Thus the base effect is a tailwind. So that's why this housing doesn't get better until August. I'm sorry, it just doesn't.
Yeah, no, that's absolutely true. And you know, this 12-month rate of change goes up when you have big jumps replacing little jumps.
Of course.
These two blue boxes.
Yep.
But what happens if this actually starts to go down?
Mm-hmm.
Right?
Yeah. Yeah.
Then we're going to have negative numbers replacing big positive numbers back here.
Exactly.
And this will just drop off a cliff. But it takes time. It takes 12 months for that to happen.
Exactly. That's why I'm calling August and July and August being the time the second part of inflation will start rolling over. And then we talk about the hard stuff being wages. We'll see.
Yep. Yeah, wages is something to keep an eye on. This is actually something that I put in my newsletter, and by the way, these are the earnings for next week.
Mm-hmm.
There's some more banks.
Yeah, Tuesday banks.
Some of the banks last week were okay.
Yeah.
I mean,
yeah, they all reserved for bad debt.
I didn't see a lot of negative earnings.
Well, Wells Fargo was the disappointment. The other three were fine.
Yeah. Got Netflix next week reporting.
Yeah, we do. Yep.
A lot more banks coming in next week.
Mm-hmm.
So I talk about this and this and this. This we'll talk about in the next session. Where's the one I wanted to show? This one right here. This is from Real Investment Advice. It's a pretty good newsletter. They pointed out this pattern, which when they show it like this, it's pretty clear. I went back and looked at my charts, and yeah, it's on there too. But remember that 4,000 level that we just talked about? Mm-hmm. There's where it closed, 39.9909. But there's an inverse head and shoulders right here.
Yeah.
Right, left shoulder, head, right shoulder. And there's the neckline. So that puts it at right about 4060 roughly.
Okay. Yeah.
So that's why I say if it gets above 4100.
Yeah.
You know, all the new traders are looking at this. They're looking at this inverse head and shoulders and saying, if it breaks out of here, then I'm in. And all of those stops, those buy stops are up here too.
Yeah, it's gasoline, right? Yeah.
It's like gasoline on the fire. Exactly. Now, the way head and shoulders work is you take the neckline to the head, the distance, and this is about 4,100 to, it's not an exact science, so I'm going to make it 3,600 right here.
Okay.
Even though it dropped below that, it was just one bar.
Okay.
So 3,600 to 41 is 500 points. If you add 500 to 4,100, what do you get?
46. That's why you're calling 40. I got it.
4,600, which is also this resistance level right here.
All right.
So if we get through 4,100, like gasoline on the fire, like you said, and we've got major support at 43, so we could go to 43 and go sideways, or actually 43 and come down, and then back up again. But then 4,600, and then we'll have to see what the market wants to do at that point.
Very cool. Where
does it want to go? So the last thing I want to show in this section, I know what I wanted to point out. This chart right here, I actually had a link in here. Somebody sent me a note saying the link didn't work. That's this one right here. During the earnings beat market vision from last week, Dave Keller had a really good talk, and he said, you know, I was asked if I had just one chart to look at, what's the chart that I would look at? The one chart to rule them all. So this is the one I would look at. I'm going to click on it to see if it works here for me, and it does. So I don't know why it didn't work for that one person, but basically this is the S&P here in the middle with the downtrend line. The one down here, I've showed these before, the percentage of stocks above their 50-day moving average.
We're getting pretty rich.
That is what's that?
We're getting pretty rich. Lots of people above their 50-day.
Above the 50, but it's not up at the 90 yet. So there's still room to go.
Okay.
And more importantly, it hit the 50%. 50% is the key.
Oh, okay.
If it's above 50%, then the market is in an uptrend. You can see here, starting, beginning of the year,
Got it.
it was mostly above 50%. The market was going up.
Mm-hmm.
For the most of this year, it's been below 50%. The market's been going down.
Got it.
The next one is the advanced decline line, the number of stocks advancing versus the number declining. This is the New York Stock Exchange. And I put this trend line right here, actually resistance line. So this has gone through that, which means there are more stocks advancing than there are declining.
Interesting. Okay.
The next one is percent bullish, S&P 500 bullish percent index. So the number of traders that are bullish versus bearish. And when this gets way up here, then that means everybody is bullish. Is usually the time when the market's going to roll over, start going back down. Although it can stay up there for a while. But we're not there yet. So above 50, again, means more people are bullish than they are bearish.
Okay.
And then the last two down here is discretionary versus staples. I've showed this before, but the ones that I showed were the XLY versus the XLP, which is weighted, meaning Tesla and Amazon make up 40% of that whole index. Those two together make up 40% of the index, whereas this one is equal weighted.
Oh, okay.
So it takes that weighting away from Tesla and Amazon and makes them all weighted the same. So this is discretionary, what people want to buy, versus staples, what people have to buy. And that has just been going sideways since June. Just beginning to start to go up. And the last one that hasn't really broke out yet is growth versus value. Now, what this tells me, growth is still not performing very well. The technology area, semiconductors, software, all of that, all those growth stocks are still not really performing very well. What that tells me, with the market making maybe a new higher low, we don't really know yet until it gets above this last higher high.
Okay.
Right? So that's not really a higher low until this gets above this higher high. But it looks like we might be making a higher low, which means the market is starting to trend higher, even though growth is still underperforming. So what that means is growth is not driving the market higher like it did in 2021.
Right.
Other sectors are doing that. Energy, industrials, materials,
banks,
financials. Right. Those are driving it higher. So money is rotating out of this growth area and rotating into those other sectors.
I agree.
So that's what this tells you right here. And then the last thing I want to show is VectorVest. I talked about this and I actually showed it in the newsletter. This is put a date line right there. So that's Friday.
Okay.
This is a great market timing system for those folks that are looking for a platform to help them and they're just starting out. I think VectorVest is a great one. It can keep you out of trouble. There are two things that I like to follow. One is called the DEW, which is the DEW. D standing for Detrended Price Oscillator. That's this blue one down below.
Okay.
The E stands for envelopes. So it's the blue envelopes that this typically trades within. When it gets to the extreme of the envelope, it usually goes the other way.
Okay.
And then the W is the weighted moving average, which is this white line right in the middle. It's a 30-day weighted moving average. Now, you don't get a green light like this unless the price gets above the weighted moving average, like it did right there, and the DPO goes above 1. So both of those things have to happen. And that happened on January 10th.
Interesting.
This is a really good intermediate signal. And you can go back here and look. I gave a down signal right there, gave an up signal way back here. So if you just traded it just based on the signal, you would basically have been on the right side of the trend. Gave a down signal way back here in August. And then didn't give an up one until October. So if you did nothing other than just trade this and just trade the index, then it would have kept you on the right side. There's another one that's more conservative and lasts longer called confirmed calls. And you can see here, the confirmed call didn't kick in until November in this case, whereas the due kicked in way back here. So it's a little earlier signal, and I like that one better. But the interesting thing that just happened this week, here's the DEW right here on the 10th, but the confirmed call happened on the 9th.
Ah.
That usually doesn't happen. It's usually the DEW first and then the confirmed call. But in this case, the confirmed happened first. Now they're only 1 day apart. But I just thought it was interesting that they both happened so close to each other. That's a pretty positive sign, actually. And then finally, let's look at the portfolios. These are the dividend payers that I talked about.
Yep.
2 weeks ago.
Yes.
They're up 2.4% in 2 weeks.
Nice.
Again, if you I went through how I did a back test on these back a couple of years, and even last year it was up 25%. If you had done nothing more than just bought these and left them alone, did nothing for a year. And that's, that's not what I did with these, but that we're just playing with it to see what it will do.
Yeah, we're just playing. Yeah. Cool.
And you can see there's only 2 of them that are negative.
Yeah, Chevron and
Pfizer.
Pfizer. Oh, there you go.
Pfizer down almost 7%. But the other ones are up pretty nice.
Yeah.
So 2.4% in 2 weeks is not bad.
No, it's not horrible. Well, Dan, do me a favor, flash your newsletter one more time, and we will get into the January effect in video number 2.
Yeah, and I'll just give my opinion. It's not advice.
Yeah.
It's my opinion.
It's one wild man's guess.
I think the market is poised. I think it wants to go higher.
Sure.
I think it's poised to go higher. It's at an important resistance level, so it could actually reverse.
Sure.
But I think if it does reverse, it's just going to be temporary, and I think it is going to go higher.
Yeah, you've been calling for the back to 4,600 for a while now, so it will be fun to watch. There's just as many people out there calling 3,200. So do your own research.
Well, 3,200 is on the chart as well. Sure.
Absolutely.
Yep. All right, folks. Breakpointtrading@gmail.com. Just send me a note and I'll add you to the list.
Thank you, buddy. I appreciate you.
You bet.